Okay, so in this chapter, we're going to be looking carefully at portfolios of financial projects. So far, we've been focused pretty much on evaluating, on the one hand, individual financial projects. So, for example, we've been looking at something like buying one stock or bond at a time, making one loan to one home builder, that type of thing. Or on the other hand, we have sometimes looked at portfolios of projects, but really without regard to the interactions of the individual components within the portfolio. So some examples we've looked at already would be something like buying shares of the SPY exchange traded fund, and that includes 500 stocks in it, or buying shares of something like the SJNK ETF, which includes 100 high yield bonds. So these are portfolio projects, but we haven't really thought about how the individual components may affect the overall performance of the portfolio itself. So now, like I say, we're going to be looking closely at the behavior of portfolios of projects and addressing in particular two things. First is how diversification among the individual components of a portfolio can help improve its performance. And on the other hand, how to measure diversification among the individual projects in a portfolio. So let's do a quick review to help get us started on the variability or risk of returns of an investment or a project versus the investment type we're looking at. So what I've got here on the x-axis is I've got, say, annual return of an investment under consideration. So this is, and this is in percent, so this would be minus 50%, here's zero, and here's, that's optimistic, 90%, that's nice. And these are going to be here probability distribution graphs. So on the y-axis, I have my probability in percent. So let's start with by looking at a very simple investment like buying a treasury note. That would be a treasury bond investment that matures in a year. So back in the good old days, around the end of the 1970s, you could expect to get about 5% on a treasury note. And this is pretty much just a single gold line because there's almost zero probability that you're going to get anything else. So there's no spread along the x-axis there. And another thing, let's contrast this treasury note investment with a couple of other investments. For investment A, it could be something like a high yield bond or just a pile of high yield bonds that we've put together. And the first thing to notice here is that the average return that we'll get for that bond or those individual bonds is higher than what we've got for the treasury. But now look what's happening. Now we have a distribution of returns. So sometimes if you buy a pile of high yield bonds, they're not going to do very well. And you might get on average a loss of 10% down here or even more. On the other hand, if none of them magically default, you may get a wonderful return like a 40% return, something like that. And now let's look at a third investment, which could be a stock or just a random pile of stocks that we've put together. And you see here that the average return for this pile of stocks that we're putting together, or one stock that we keep investing in year after year after year after year, the average return is higher now than for high yield bonds, and it's also higher than the treasury note. But now look at the spread, look at the distribution of returns here. We could have very big losses, right? And we've seen this type of thing in the marketplace recently, speaking in March of 2021, where the extreme tech high flyers, some of them have just crashed terribly in the past month or so. And on the other hand, if everything goes our way, we might get really, really high returns, something like what the ARKK ETF got in the year 2020, something something like that. So the basic takeaway here is it looks like if you want to get a higher return on average, you have to increase your risk. Your risk is going to be measured by how big is this downside tail, right? How far can we go over here? And we can measure that by standard deviation or probability of loss or value at risk or something like that. So let's formalize this a little bit on the next slide and think about how could we reduce our risk of returns. Well, on the last slide, the approach was to say, well, if we really want to decrease our risk here, we want to decrease the standard deviation of returns. Or again, looking at that left tail of the distribution, we could say we want a small probability of loss, or again, looking at the left tail, a small value at risk. And the bad news about this, as we saw on the previous slide, is that in every case that reduces our expected value return. Highest expected value return, biggest tail over here, biggest standard deviation, biggest probability of loss, right? And with our high yield bonds, we have a lower expected value, but the nice thing about that is we have a tighter distribution and less probability of a very big loss in particular. Also, of course, less standard deviation of returns. And if we go all the way to the Treasury, unless the United States government blows up, which hopefully is a very small probability, we're absolutely going to get just what the contract says. We're going to get the promised amount. However, there is another approach that is much more exciting. We can invest in a diversified portfolio of projects with the emphasis on diversified. And what we mean by that is a portfolio of projects or investments that are poorly correlated to each other. And we're going to measure a correlation mathematically, but just qualitatively, if two stocks or two bonds or a stock and a bond move in price up and down together, they're highly correlated. If they move up and down in price opposite of each other, they're very poorly correlated. And the beautiful thing about this Plan B approach is that this strategy is going to reduce our standard deviation of our portfolio. This is going to reduce our portfolio returns standard deviation, but will not reduce the expected value. So it's sort of like magic, okay? And caveat here, correlations have to remain static, which isn't always quite true, but we'll get to that later. So this is, in good times anyway, a true free lunch. And a lot of people say that the single free lunch in finance is diversification. So very helpful, very important. So now let's think a little bit about diversified portfolios of projects versus undiversified investments. Let's just kind of classify projects or investments along the lines of diversified versus undiversified. So I've got our little table here, investment type, example of this type, and is it diversified? Yes or no? Okay, so if we look at a single project, we've looked at a lot of single projects this semester, something like we buy shares of Tesla or we make a loan to the Kia Corporation. These are never going to be diversified. A single project can never be diversified because all of our eggs are in one basket. In fact, we only have one big egg in our basket, so if we drop that basket, we lose it all. So you heard it here first. Within 5 to 10 years, when hydrogen power comes to overtake battery power because it's superior in every way in 5 or 10 years, Tesla will either have to convert itself to a hydrogen-powered car company or get squashed like a bug and die. And similarly, Kia Corporation could go bankrupt. There's all manner of car companies that have gone bankrupt. Okay, let's look now, let's contrast that to a portfolio of projects, but now this is going to be similar projects. Okay, so what do we mean by a portfolio of similar projects? Well, portfolio means a bunch of projects, right? And similar is going to mean something like this. Let's say we have a lending company and all we do is make loans to 5 property management companies in Oxford, Ohio. Is this a diversified portfolio? No. And the reason why we could see again in the COVID crisis is that virtually all of the property managers in Oxford, Ohio are focused on student housing, and the student housing demand completely collapsed in COVID. So if we had made 5 loans, very high probability that all 5 companies could have gone bankrupt during the COVID crisis. So even though we have a portfolio, we have a bunch of projects, because it's not diversified, it's not really very good. So let's see if we can do better. Let's look at a couple examples of portfolios of dissimilar projects. So a simple example would be, let's buy one stock from each S&P 500 business sector. In the S&P 500, there are 11 sectors, including finance, energy, communications, consumer discretionary, consumer non-discretionary, stuff like that. So if we bought, for example, Google and we bought GM would be consumer discretionary, et cetera, et cetera. We bought 11 of those, then we'd be kind of diversified, right? Because it's not necessarily true that the medical industry, which is one sector in the S&P 500, is going to be doing very badly in a recession when consumer discretionary companies like GM are going to be doing badly. So that might help us. And now let's see, though, if we can do even better than that. How about if we do something like buy a share of the SPY ETF? Now, the SPY ETF, as we know, gives you, if you buy one share, that gives you fractional ownership of 500 companies in the S&P 500, drawn from the 11 sectors. So of those 500, you have about 90 each, or whatever the math works out to be, in each of those 11 sectors. So because we have all 11 sectors, and now we have so many stocks, not just one in each sector, now we're really very well diversified. So why is this so important to have a diversified portfolio of stuff? This is the super important graph that explains it. If we look at number of assets in our portfolio, number of projects in our portfolio, and we measure risk by sigma, VAR, etc., doesn't really matter. As long as we keep adding into our basket of eggs that are poorly correlated to each other, the more eggs we have, the less standard deviation, the less value at risk we're going to have in the overall portfolio. And that comes down to, once we get to about 30 or so assets in our portfolio, it's sort of asymptotically leveling off here. So this is why investing in a diversified portfolio is so helpful and all that stuff. So we're going to use correlations for this really big important reason, and we're also in this chapter going to use correlations to understand how an individual stock's returns compare to the returns of the overall stock market. And we looked at some mathematical measures of correlation. The first one was the correlation coefficient. You definitely need to know what the correlation coefficient is and how it works. So it's measuring how much two random variables tend to move together, ignoring amplitude effects. You don't have to worry about these formulas. If you wanted to compute the correlation between returns of, say, the spiders and Intel over 30 years, you could use this formula and it would work great. But I'm not going to ask you to do that. What you do need to know is this. For two assets that are very highly correlated, they're moving essentially identically. So the return of one is 10%, the return of the other one is more or less 10% in the same year. When they move identically, they'll have a correlation coefficient of 1. If they're moving opposite to each other, okay, then you're going to have a correlation coefficient of -1. And if you just absolutely cannot predict what's going to happen with one from the other one, you get a correlation coefficient of 0. And I showed you some actually reasonable real-world examples of how you could get these correlation coefficients. And then here are some graphs of them, and in these graphs, the rho xy, or correlation coefficient, is called R. So here's highly negative with minus 0.9, and here's negative, but you see it's more scattered, so it's minus 0.5, and that has to do with it being scattered. And if you look at this, clearly you can see here, if we know the return of x, looking at these dots, there's no possible way we can predict what's going on with y. We can draw a line through this and make kind of reasonable prediction, and we can draw a line through this and make a really good prediction of what's going to happen with y based on x, but we can't do it here. So here's a loosely positively correlated with correlation coefficient of 50%, 90%, and 1 would be just perfect. Okay, our second measure of correlation is beta, and beta, you definitely need to know what beta is also. Beta is measuring how much two random variables move together, including the amplitude effect differences. Okay, so let me just highlight that. And beta comes, there are two ways to get beta. The most common way is from a linear regression, and it works just like this. So let's say we are interested in comparing our ETFY to the returns of ETFX. We try to make a linear regression line between y and x, y equals alpha plus beta times x plus error, and we use our standard square error technique to minimize the error term, and then beta is the slope of the line. So here we go. Here's our regression, and here's our line. Beta is the slope of that line. So I've done a regression for y2x for this data, these 4 points, and you can see the diamonds here are my 4 actual points, and the line and the orange squares are the best line fit line we could fit through there. And what are the characteristics of the line? They come from the regression. So the intercept down here, a little bit negative, and the slope is 1.6, and the R squared is 98. That means that 98% of the performance of y can be predicted by what's going on with x. So that's a really good regression. And the graphs for beta look very similar to rho, positive, negative, and here if we just cannot tell what's going on with y from x, beta, like rho, would be equal to 0. All right, so there's also a formula for beta. If we know rho, this might be a good thing to know for the final, that beta b to a is equal to rho ab times sigma b divided by sigma a. So you don't need to do a full-blown regression to get beta from that. You just need to know the correlation coefficient. Okay, and then we used this graph here to show you what we mean by rho not including any amplitude effects and beta including those effects. So A is the blue line here, everything else is relative to A. So for B, we have, even though the amplitude is twice of A, its correlation coefficient is 1. It gets maxed out at 1. C is exactly opposite A, so we got -1. D is exactly opposite A, but with twice the amplitude, and it's maxed out again at 1. Beta, on the other hand, if we look at the beta of B to A, we have 2, which includes that amplitude effect, that the returns of B are always twice as much in absolute value as the returns of A. And we see the same thing over here with D. D is completely negatively correlated to A, but with double the amplitude, we get that in beta, we don't get that in rho. So beta is really giving us more information, okay? And I think everything that's said there, we just talked about. Okay, so let's keep going. So we've got our 2 uses for beta and rho. Number one is building diversified investment portfolios. So what do we mean by that? So you're a portfolio manager in a company for a hedge fund, for a mutual fund. Define your mission, build a portfolio of mission fitting investments, and you want to do that. They've got to be mission fitting, so they've got to be in the right industry and all that jazz, but you want to find ones that have big differences in beta and or rho, and then you've got your diversified portfolio. So that's really cool. So the problem with this is, as always with our models, they're not so great, right? Our models are really not so great in finance. It's a bummer, but it's a fact on the ground. Okay, so what's wrong with this picture? Are correlations static? No, unfortunately, just when you don't want this to happen, the correlation coefficient between everything and everything else goes to 1, and that typically happens in recessions and depressions. So that's bad. Does the future look like the past? We've talked about this a lot. Generally, often it does not. Sometimes it does, but often it does not. Okay. And also this model saying smart investors always invest in diversified portfolios. So what's that telling entrepreneurs? It's telling them you're stupid. You're putting all your eggs in one basket. You shouldn't be starting a new company. You should be investing in a diversified portfolio of existing companies. Okay, and this is good to know because we do want to quantitatively be able to build not a diversified portfolio of 30 assets, which is a little bit beyond the scope of this course, but how about a portfolio of 2 or 3 different things? So we got the expected value return of our portfolio is just the X's are the weights, so the X's are the weights, so the expected value return of our portfolio is just the weighted average of the expected value of the components of the portfolio, and the variance of our portfolio follows this formula. It's not really that hairy. Just write everything in carefully and then be careful to make sure you remember that that formula is for the variance and the standard deviation is always the square root of the variance. Okay, so the second thing that we use beta and rho for is to help understand how the returns of an individual investment compare to the overall market. And mostly, honestly, we use our regression with beta, and we're also going to include alpha for this. So how do we compare an individual ETF or stock or something like that to the market? Well, we go out and we get our bunch of historical returns for our market proxy, which is typically going to be the SPY ETF or something like that, and then get a similar list of historical returns for our prospective stock or ETF. And then we do want to go ahead and perform our linear regression of the ETF or the stock we're interested in versus the stock market. So you always want to put your stock market on the x-axis there and look at the returns of our prospective stock or ETF on the y-axis. And we're going to get something like the red line here, where the slope is going to be beta from the linear regression and the intercept is alpha. Also, it's important to note here, there is this thing called the market line. If we regressed the market to the market to itself, the regression line we would get would be this line with an intercept of 0 and a 45-degree slope or a beta of 1. That's called the market line. Let's think about this regression that we've done to compare our individual stock to the market. So if our individual stock behaves just like the market, it's going to look like the market line regression, beta equals 1, 45-degree slope, intercept at 0, alpha equals 0. So let's look at some more interesting cases. If we have, like we have over here, a slope of less than 1, here, that is our beta less than 1, and that corresponds to less than a 45-degree slope. And what that means is that our prospect stock is less volatile than the market. And that's important because it tells us less volatility drag, less risky than the market. So it might be okay to have a lower average annual return there. And if, on the other hand, when we do our regression, we get a beta that's greater than 1, it's telling us our prospective stock or ETF is more volatile than the market. We have more volatility drag, so we're going to overcome that. There's nothing wrong with that, but to overcome that, we want to have a higher expected value. Okay, and now let's think about our intercept, which is equal to alpha. The way to interpret the intercept, this is actually very important too, is that it's the return that we expect on average when the market return is 0. And you can see that right here. The market is returning 0 and we're getting alpha, and that's way super cool. So when alpha is greater than 0, alpha is the excess return over the market. And we talked a lot about investors who focus on that, and let me go over that a little more here. Alpha-focused investors are always looking for a high alpha. Okay, so when the market's not doing anything, they're making a lot of money, and their sort of holy grail would be a line like this, that no matter what the market is doing, they're making some return alpha here. So those are our alpha-focused investors. And so they want to give us a consistent return. The key here is irrespective of the market's performance. And beta-focused investors are always looking to compare themselves to the market. Okay, they're always looking for performance relative to the market. So these are the types of investors who say our benchmark is the S&P 500. That's what they're always comparing themselves to. Okay, so they might be looking to have a beta less than 0. So they'll say we want to follow the market generally, but be a little bit less risky. And they'll say we want to follow the market generally, but we want to do better when times are good, and we think we'll have a higher expected value return. But the key thing is they're comparing themselves to the market. Okay, and last little note here, risk-free securities like treasuries are assumed to have no correlation to the market, so they're going to have a beta of 0. And the last thing we talked about in this chapter is the fact that a lot of equity-focused investment firms are going to show you graphs like this and say, you know, over the long run, the pile of money that you get by investing in stocks is much bigger than the pile of money you're going to have by investing in bonds or just keeping up, putting your money in a money market and keeping up with inflation, something like that. And they'll always show you a graph like this with almost 100 years worth of data, and you can't really look at that, as John Maynard Keynes would say, if you look at the period from, say, 2000 over to 2009, you could have lost 50% of your money, not once, but twice. And if you only have a 10-year for example, investment horizon, you could lose 50% of your child's college tuition and not be able to send them to college. So it's very important also, the more volatility drag you have, the higher risk you have, the longer your investment horizon needs to be, so you have time to recover when bad things like this happen, bad things like this happen, very bad things like this happen. If you don't have a long time horizon, you should be investing in something with less volatility drag.